They succeeded. For numerous days, we issued warnings that as the scheduled monthly options expiration drew near, the major financial institutions would attempt one final, desperate strategy to salvage their financial statements. We cautioned that they would exploit the prevailing market uncertainty as a smokescreen to execute a significant liquidity purge. Our advisories highlighted their intention to manipulate market sentiment, specifically to paint the trading screens red, aiming to convince the public that the bull market had definitively concluded. Today, Thursday, January 15th, 2026, they implemented their plan. Observe the accompanying graph. Within mere minutes, the value of silver plummeted from its morning peaks, which were hovering close to $93, down to $86. This represents a precipitous decline of nearly 8% within a single trading session. Let me be unequivocally clear regarding the events you are witnessing. In a properly functioning marketplace, a commodity does not surrender 8% of its valuation in such a brief time frame. Such a drastic drop would only be justifiable in the face of a calamitous news development, perhaps the catastrophic collapse of a major mine, the swift conclusion of a global conflict, or the improbable discovery of an entirely new continent rich in silver deposits. None of these extraordinary circumstances occurred today. The underlying economic fundamentals remained unchanged. The robust industrial demand for silver did not vanish. The price of silver in Shanghai did not experience a collapse. So, what precisely transpired? We were witness to a coordinated assault on the paper market. A recent urgent update was disseminated by KBC, a highly reputable firm specializing in institutional market analysis. They characterized the current volatility observed in commodity markets as truly astonishing. Their assessment is accurate. It is indeed remarkable. However, it is not beyond explanation. This market downturn was deliberately engineered. It was a precisely targeted operation designed to trigger the automatic stop-loss orders of individual traders who had previously bid up the price to $92. The financial institutions possess visibility into these stop-loss levels. They are intimately aware of the precise price points where these protective measures are activated. Consequently, today, they deliberately drove the price down to that critical threshold, compelling you to divest your holdings. The question arises, why would they engage in such aggressive price manipulation, especially when they are acutely aware of the strained conditions in the physical market? The answer lies squarely with the options expiration. Billions of dollars are presently tied up in call options, speculative bets that the price of silver would increase, which are scheduled to expire this week. Should the price of silver conclude the trading week above $90, the institutions that sold these options would be obligated to make substantial payouts, resulting in potential losses amounting to billions of dollars. However, by orchestrating a rapid price collapse to $86, even for a few hours, these options would expire worthless. This maneuver allows them to expunge these liabilities from their balance sheets and retain the associated premiums. For them, this is an exercise in fiscal survival. Their trading decisions are not driven by intrinsic value, but by the imperative of managing their financial obligations. However, this abrupt price drop presents a perilous trap for the uninformed investor. When confronted with such a substantial red candlestick on the chart, the immediate emotional response is fear. The primal instinct screams, "The rally is over. I must exit immediately." Mainstream media outlets will invariably amplify this sense of dread. Their headlines will likely focus on profit-taking, discuss technical corrections, and proclaim the bursting of the speculative bubble. Their objective is to direct your attention to the screen, diverting it from the tangible reality. Because while the price displayed on the screen plummeted to $86, the price on the actual street operated in a fundamentally different manner. It ascended. We are receiving numerous reports from physical silver dealers across the nation indicating that the actual transaction price of silver has effectively detached from its paper counterpart. When the paper price declined by 8%, did the dealers correspondingly reduce their asking prices? No. Did the premiums paid for physical silver shrink? Absolutely not. The premiums actually expanded. The genuine market price remained steadfast. This phenomenon unequivocally confirms that the drop to $86 represents a phantom valuation. It exists solely within the leveraged trading environments of Chicago and New York. It holds no relevance in the real world where actual exchanges of currency for tangible metal occur. If you choose to liquidate your silver holdings today due to this price decline, you are effectively surrendering a real asset based on an illusory signal. You're transferring your wealth directly to the very entities that orchestrated this market manipulation. The dramatic price collapse experienced on January 15, 2026 will undoubtedly be etched in history as the pivotal moment when the paper silver market definitively forfeited its credibility. It marks the instance when the manipulation became so blatant, so forceful, and so divorced from underlying economic reality that its efficacy began to erode. Rather than deterring prospective buyers, this sharp price reduction has inadvertently served as a siren call to significant market participants. Consider this scenario. If you are a major corporation like Samsung requiring silver for your battery manufacturing and you observed the price at $93 yesterday, how would you perceive the current price of $86 today? You would likely feel immense satisfaction, viewing it as an extraordinary discount. The banks, in their efforts to protect their options portfolios, have inadvertently provided a subsidy for industrial silver accumulation, particularly from Eastern markets, by artificially suppressing the price. They have effectively made silver more accessible for the entities that are actively depleting existing reserves. It is akin to burning precious furniture to provide a brief warmth for a single night. In the subsequent segment of this comprehensive analysis, we will delve into the intricate mechanics of this options-based manipulation. We will meticulously explain precisely how financial institutions leverage their resources to influence prices without the physical movement of even a single ounce of silver. Furthermore, we will elucidate why this particular form of market volatility, often referred to as a rug pull, almost invariably precedes a significant and rapid upward price surge. The display screen may indicate $86. The financial institutions intend for you to accept this figure as truth. However, you must not. While the banks were diligently engaged in manipulating the trading charts, while algorithmic trading systems were engineered to drive down the paper price to $86 to safeguard their options positions, a profoundly significant event unfolded in the physical realm. An event that irrefutably demonstrates that the $86 valuation is a fabrication. Typically, when the price of a commodity experiences an 8% decline, what transpires? Sellers become more eager to offload their inventory. Retail outlets often display prominent sale signs, attempting to move merchandise before further depreciation. However, today, despite silver's 8% price drop, the retail outlets did not advertise sales. In fact, many chose to cease operations. We have received authenticated reports confirming that the United States Mint, the official coinage and precious metals production entity of the U.S. government, has temporarily suspended sales of the American Silver Eagle coin, along with over 37 other numismatic silver products. A careful examination of the official notice reveals their stated reason: a halt in sales to recalibrate pricing amid surging demand. Consider the inherent contradiction within this statement. The spot market price has just experienced a significant collapse. If the market were functioning as intended, the mint would logically be lowering its prices and potentially receiving a surge of newly available silver from the market drop. Instead, they are asserting an inability to adjust their product pricing quickly enough to accommodate the overwhelming demand. This situation effectively represents a physical market default at the consumer level. The United States Mint operates on a cost-plus pricing model. They procure silver blanks, mint the coins, and then offer them for sale at a modest profit margin. If they are compelled to discontinue sales, it implies an inability to acquire the necessary silver blanks at a price that is economically viable. This, in turn, signifies that the paper market price of $86 is not a workable figure for the U.S. government. When the mint contacts its suppliers with an offer based on $86 per ounce, the response is a complete lack of engagement. The suppliers are demanding significantly higher prices. Moreover, the mint is not an isolated case. Examine the private sector. APMEX, recognized as the largest precious metals dealer in the United States, has recently implemented a stringent new policy. As of this afternoon, they have instituted a minimum order requirement of $10,000 for all buyback transactions and have imposed restrictions on the sale of pre-order items. A $10,000 minimum order is a form of de facto rationing. By establishing such a high threshold, they are effectively barring the average American saver from participating in transactions. Their message is clear. Smaller investors are not a priority. Their focus is exclusively on larger volume transactions. Why would a business voluntarily turn away potential customers? Why would they create obstacles to purchasing? The explanation is simple. They are overwhelmed. They are facing a scarcity crisis concerning the physical goods themselves. There is an excessive amount of capital chasing an insufficient quantity of precious metal. Their logistical infrastructure is buckling under the strain of the immense volume of panic-driven purchases. This leads us to the most critical data point of the day, the figure that unequivocally exposes the inherent fallacy of the paper market's valuation. We are receiving consistent reports from physical silver dealers nationwide indicating that the effective street price, the actual amount one must pay to physically possess silver, is currently fluctuating around $120 per ounce. Observe the disparity. The paper price stands at $86, while the physical price is $120. This creates a difference of $34. This indicates a market that has effectively fractured into two distinct segments. The paper market and the physical market are no longer synchronized. They are operating in entirely separate economic realities. A $34 premium represents a 40% markup over the prevailing spot price. In a typical healthy market, such premiums typically range between $2 and $3. This substantial spread provides definitive insight. The spot price is no longer a reliable indicator. It has become an antiquated metric utilized by financial institutions to settle speculative paper trades. It bears no correlation to the actual cost of acquiring physical silver. When you observe the price declining to $86 on your screen and experience that unsettling sensation of apprehension in your stomach, you must direct your attention to the $120 street price. The financial institutions may be able to drive the paper price down to zero or even into negative territory. However, if a physical dealer is demanding $120, then the intrinsic worth of silver in that context is indeed $120. Today's dramatic price fluctuation, often termed a flash crash, has paradoxically served as a beneficial opportunity for physical silver purchasers, provided they can successfully locate available metal. The lower the paper price descends, the wider the discrepancy becomes, and the more rapidly the available physical reserves are depleted. By intentionally driving the price down to $86, the financial institutions have inadvertently created an exceptionally compelling incentive for arbitrage. If significant traders acquire silver on the exchange at $86 and arrange for physical delivery, they can then resell that same bar on the physical market for $120. This yields a profit of $34 per ounce. This arbitrage opportunity will inevitably deplete every remaining ounce of silver from the paper market's warehouses. It is a certainty dictated by mathematical principles. The existing exchange infrastructure cannot sustain such a profound disconnect between paper and physical valuations. Consequently, we are witnessing the closure of sales at the US Mint, stringent rationing implemented by major dealers like APMEX, and a staggering $34 price differential. This is what the term unobtainium truly signifies. Silver is being rapidly absorbed into secure holdings. It is transitioning from the observable realm of the exchange markets to the less visible domains of private vaults and industrial stockpiles. The financial institutions are fully cognizant of this development. They understand that they are engaged in a losing struggle. The aggressive price reduction to $86 was not an exhibition of market strength. Rather, it was a palpable demonstration of their escalating weakness. It represented a desperate attempt to cover their short positions before the undeniable physical realities render them entirely insolvent. In the subsequent section of this in-depth analysis, we will meticulously examine the dynamics of the Shanghai market, If you consider the price disparity in the United States to be significant, you will be astonished by the situation unfolding in China. While the Globex market experienced a sharp decline, the Shanghai market demonstrated remarkable resilience. The price gap between New York and Shanghai has widened dramatically to $14. We will provide a comprehensive explanation for why this specific numerical divergence guarantees that the paper market's vaults will be completely empty by the conclusion of the current month. The financial institutions have effectively placed silver on a global fire sale for Chinese industrial consumption, and the Chinese entities are acquiring every available ounce. We have thoroughly analyzed the market manipulation within the paper trading sphere. We have documented the breakdown in supply chains evident at the US Mint. Now, our attention must unequivocally shift eastward, as that is precisely where the most significant repercussions of today's dramatic market event will manifest. While the algorithms operating in New York were intensely focused on driving down the price to $86 to protect their speculative options bets, the Shanghai Gold Exchange transmitted a message that should instill considerable concern among central bankers in Western nations. They did not engage in widespread selling. They did not succumb to panic. They simply widened their price differential. We have received confirmed reports indicating that the premium for silver on the Shanghai market has surged to $13 per ounce above the international spot price. While Globex was trading at $86, silver on the Shanghai Futures Exchange was still changing hands at prices exceeding $100. Perform the simple calculation. This represents a $14 disparity between New York and Shanghai. Within the intricate domain of global logistics and commodities trading, a $14 differential is not merely a spread. It is a critical indicator signifying impending financial difficulties for the paper market. By intentionally suppressing the paper price to $86, the Western financial institutions have, in effect, placed the entirety of the United States silver reserves on an unprecedented clearance sale for the benefit of China's expansive industrial sector. Consider the perspective of a trader operating in Beijing. Yesterday, they were obligated to pay approximately $100 for silver. Today, the American market is effectively offering it to them at $86. Do you genuinely believe they would perceive this as a market collapse? On the contrary, they would likely see it as an unparalleled opportunity. Would they question the sanity of the Americans? Absolutely. And they would proceed to purchase, acquiring as much as they possibly could. This action precipitates a powerful vacuum effect. Every available ounce of silver located in London, every bar held within vaults in New York, is now a prime target for export. The potential arbitrage profit is so substantial that it comfortably covers the costs associated with shipping, insurance, and security measures by a factor of 10. The financial institutions believe they are safeguarding their own positions by driving down the price. In reality, they are accelerating their own eventual downfall. Had the price remained at $93, the depletion of physical reserves would have occurred at a gradual pace. However, at $86, this depletion transforms into a veritable torrent. They are actively incentivizing the very outcome they are desperately attempting to avert: the physical exhaustion of Western silver inventories. We term this phenomenon the paper trap. The more vigorously they attempt to suppress the paper price, the more rapidly the physical metal is extracted from their control. They are in an untenable position. If they are compelled to raise the price, they face insolvency on their short positions. If they lower the price, they risk losing their physical inventory to China. This is precisely why the Shanghai Premium has emerged as the most critical market indicator globally at this juncture. It serves as a quantifiable measure of the desperation differential. It vividly illustrates the disparity in the perceived value of silver between a manufacturing-driven economy and a speculative financial economy. China requires silver for the production of solar panels and is a critical component of their energy transition initiatives. They regard it as a strategically vital resource. Conversely, the United States often views it primarily as a stock ticker symbol subject to speculative trading. Today's drastic price reduction serves as irrefutable evidence that the U.S. silver market is fundamentally compromised. It no longer functions as a mechanism for price discovery. Instead, it has devolved into a mere discount window for the rest of the global economy. Furthermore, observe the timing of these events. This market upheaval is occurring immediately preceding the crucial options expiration. The financial institutions are demonstrating a willingness to jeopardize the nation's strategic silver reserves solely to circumvent substantial payouts on a relatively small number of call options. This represents a manifestation of short-term avarice, leading to potentially catastrophic long-term consequences. However, for the individual investor, this pronounced divergence in market prices provides critically important intelligence. It unequivocally indicates that the price drop to $86 is artificial. It is not supported by aggregate global demand. If the price were genuinely collapsing worldwide, the Shanghai market would also be experiencing a commensurate decline. However, the Shanghai market is demonstrating remarkable stability. This suggests that the price is inevitably destined to rebound. It is akin to a coiled spring. The further it is compressed downwards in New York, the greater the stored energy, and the more forcefully it will inevitably snap back upwards to align with the Shanghai valuation. We are currently witnessing the formation of a bear trap of unprecedented historical magnitude. The financial institutions have successfully convinced retail traders to divest their holdings at the market's nadir, while major international investors, often referred to as whales, are actively increasing their positions. It is imperative not to be on the incorrect side of this significant wealth redistribution. The $14 price gap is fundamentally unsustainable. It will inevitably be rectified, and it is highly improbable that this correction will occur through Shanghai's price plummeting to $86. Instead, the closure of this gap will be driven by New York's price rapidly ascending back towards $100. The Shanghai vacuum is now fully operational. The audible sound you perceive is the collective scraping of vaults being emptied. In the concluding segment of this in-depth analysis, we will meticulously examine the ultimate resolution of this complex market situation. We will synthesize all the disparate pieces of evidence: the suspension of sales by the U.S. Mint, the dramatically increased dealer premiums, and the substantial Shanghai price differential. We will then articulate precisely why this dramatic market decline is likely the final significant shakeout event preceding the market's ascent into a truly parabolic trajectory. Furthermore, we will provide you with a concrete strategy designed to successfully navigate a market environment where the displayed screen price is demonstrably false and the actual cost of acquiring the commodity is prohibitively high. The paper price experienced a sharp decline, while the physical price surged dramatically. Which of these two indicators should you trust? We have reached a definitive conclusion. If you have diligently followed this emergency broadcast, you now possess a comprehensive understanding of the intricate deception that unfolded today. You grasp that the price collapse to $86 was a calculated manipulation of the paper market deliberately engineered to shield financial institutions from their options expiration liabilities. You comprehend that the demonstrable physical supply breakdown at both the U.S. Mint and APMEX provides conclusive evidence of dwindling physical inventory. And you understand that the ongoing Shanghai vacuum is relentlessly drawing the remaining Western silver reserves at an unprecedented rate. The evidence presented is overwhelming. It is forensic in its detail and undeniable in its implications. Today, Thursday, January 15th, 2026, will be historically recognized as the precise moment when the silver market fundamentally fractured into two distinct entities. We are no longer observing a singular market with a unified price. Instead, we are witnessing two entirely separate economic realities engaged in a struggle for dominance. On one side, we have the abstract world of paper transactions. This is the domain of the exchanges, the sophisticated algorithms, and the high-frequency traders. Within this realm, silver is valued at $86. It is characterized by extreme volatility, a downward trajectory, and an atmosphere of palpable apprehension. On the opposing side, we have the tangible world of physical assets. This encompasses the operations of the U.S. Mint, numerous physical dealers, major industrial consumers in China, and prudent, informed investors. In this sphere, silver is commanding a price of $120. It is characterized by acute scarcity, deliberate rationing, and its classification as an unobtainium. The chasm separating these two divergent markets amounts to $34. This $34 spread represents the pervasive lie, the extent to which the existing financial system actively suppresses observable economic reality. However, as established principles of physics demonstrate, pressure inevitably builds until it finds an outlet. Therefore, what is the ultimate resolution? There are fundamentally only two plausible scenarios through which this significant price gap can be closed. Scenario 1. The physical price of silver plummets to $86. For this to materialize, there would need to be a complete cessation of global demand for silver. Corporations like Samsung would have to halt battery production. China would need to cease its aggressive accumulation of silver reserves. The United States Mint would miraculously need to discover millions of ounces of previously unaccounted for inventory. Given the comprehensive analysis of underlying economic fundamentals, the inelastic nature of demand, the demonstrably depleted state of physical vaults, and the strategic hoarding behavior, this particular scenario is mathematically implausible. Demand is demonstrably accelerating, not decelerating. Scenario 2. The paper price of silver experiences a rapid and dramatic ascent, converging with the physical price. This represents the only viable path forward. The $86 price displayed on your screen is effectively a compressed spring. The further it is forcefully pushed downwards, the greater the potential energy it accumulates. And once the option's expiration period has passed and the financial institutions are compelled to release their pressure on the market, that stored energy will be unleashed with considerable force. We are currently setting the stage for a dramatic price reversal, one that could propel the price from $86 to $120 in an instantaneous fashion. The paper market is fundamentally obligated to align with the physical market price, or the integrity of the exchange itself will be irrevocably compromised. This brings us to a definitive verdict for the individual investor. I understand that today's events have been exceptionally challenging. Witnessing an 8% erosion in your investment portfolio within a single hour is undeniably painful. It can induce a sense of profound unease and prompt you to question the validity of your investment thesis, perhaps leading you to believe that the financial institutions wield insurmountable power. However, it is imperative to consider the opposing side of this transaction. When you elected to sell your silver today, assuming you did so, who was the ultimate purchaser? The United States Mint was not acquiring it. They are currently closed for sales. The general retail public was not able to purchase it. They are effectively excluded by minimum transaction requirements. The entities actively acquiring silver at the $86 price point are precisely the same entities that orchestrated this market manipulation. The financial institutions successfully covered their short positions. Chinese wholesale buyers meticulously filled their cargo containers. Major industrial conglomerates replenished their strategic reserves. They shook the tree and they collected the fruits that fell. Do not permit them to claim your valuable assets. This significant market decoupling presents a sophisticated trap for those with weak resolve, while simultaneously offering a substantial advantage to those with strong conviction. If you are presently in possession of physical silver, the price displayed on your screen is of negligible consequence. Your ounce of silver remains precisely that, an ounce. And according to reports from physical dealers, that ounce is currently valued at $120, irrespective of the ticker tape's pronouncements. You hold the only asset class that is entirely free from counterparty risk within a financial system that is exhibiting clear signs of systemic failure. The fact that the U.S. Mint is incapable of accurately pricing its own nation's coinage serves as the ultimate signal. It indicates that the U.S. dollar is progressively losing its fundamental ability to serve as a reliable measure of value. When the measuring instrument itself malfunctions, the blame should be attributed to the flawed instrument, not to the object being measured. Silver itself is not inherently volatile. It represents a stable anchor. The US dollar, on the other hand, is the entity experiencing severe instability and potential collapse. So, what actionable steps should you consider taking this evening? Firstly, disengage from your trading screens. The price information you are observing is fundamentally deceptive, a digital illusion meticulously crafted to extract your wealth. Secondly, examine your physical silver holdings. Hold it in your hand. Feel its tangible weight. This represents genuine reality. This tangible asset is currently sought after by billions of individuals and trillions of dollars globally. Thirdly, actively prepare for a significant market shift. Today's sharp price decline to $86 was the instigating problem. The subsequent market reaction manifested as a lockout of physical buyers. However, there is a crucial third component to this unfolding narrative: the solution. The extreme volatility witnessed today, including the 8% price crash and the severe disruption of supply chains, has garnered the attention of the highest echelons of governmental power. The administration recognizes that a dysfunctional silver market poses a significant national security threat. They understand that building critical infrastructure, such as missiles, cannot be accomplished through mere paper contracts. Tangible metal is an absolute necessity. Moreover, they are acutely aware that sustained low prices have a detrimental impact on supply. While the financial institutions were engaged in aggressively driving down the silver price, President Trump was concurrently signing a crucial document that possesses the potential to fundamentally alter the silver market landscape for the foreseeable future. This document acknowledges the inherent dangers associated with persistently low commodity prices and proposes the establishment of a price floor for the market, thereby ensuring American economic independence. The financial institutions are actively advocating for lower prices, while the government is poised to champion significantly higher prices. In our forthcoming broadcasts, we will provide a detailed breakdown of President Trump's proclamation. We will conduct a thorough analysis of the executive order that was officially signed today and explain precisely why it effectively imposes a government-backed price floor on the valuation of silver. The financial institutions may have secured a tactical victory today, but the overall war is about to fundamentally change. Reinforcements are en route, and they are bringing with them price controls, not to artificially cap prices, but rather to provide essential support and stability. The era of paper-based market manipulation is drawing to a close. The political game, however, is just beginning. Remain steadfast. The genuine intrinsic value of silver is $120, and the government has now recognized the imperative for this price to increase.